Property investment, one of the most popular investment criteria favoured by the wealthy in this country. But how does it actually work? What is happening, people? My name is Robbie, and in today's video I'm going to be discussing buy-to-let property investment and why both wealthy people and regular people use it to store and grow their wealth. First things first, who am I and what do I know about property investment? I'm a specialist finance broker and I deal with property investors on a daily basis. I assist them with buy-to-let mortgages, funding for purchasing property portfolios, funding for investing in commercial buildings, bridging finance for investing in auction purchases. If funding is required to invest in property, I can help. I also invest in property myself. I currently have one buy-to-let and have bought and sold a handful of properties previously. So now you can see that I actually know what I'm talking about and have experience. You can subscribe to the channel for future videos about business, finance, property, investing, and all sorts of other things. So what is buy-to-let investing? It's exactly what it says in the name. It's buying a property with the intention to let it out to a tenant. Technically, this could be as small as renting out your spare room to a tenant. Maybe you own a 2-bed flat and you rent that out. Maybe you own an industrial unit and you let that out to a mechanic. Or maybe, just maybe, you're seriously big time and you buy shopping centres and you let those units out to Argos, Marks and Spencer's, River Island. At the end of the day, it's all buy-to-let. But how do you acquire a buy-to-let property? And more importantly, how do you get paid? I'm going to pick a random listing on Rightmove as an example. So here we have a 1-bedroom flat in Woodlands, Glasgow. Now, in the most simple terms, a buyer would look at this flat, decide that it has good rental potential for their criteria, and they would buy it. This one's offers over 129,000, so let's just call it 130,000. They now put it out on the rental market, and someone comes along and rents it for £700 per month. That's it. In the most simple terms, that is it. You buy the property for £130,000, it now pays you £700 per month. There are other associated costs like legal fees, broker fees, stamp duty and tax, and there are monthly costs like letting agents, for example. But we'll get into that. So the investors purchased this property for £130,000 and are currently renting it out for £700 per month. But there's also another way that they can make money from this property: capital appreciation. This is where the property goes up in value over time. Now, this isn't something that you can rely on technically, but historically property goes up in value over the extremely long term. So there are two ways to make money from this property: rental income and capital appreciation. These are made up numbers, by the way. I don't know if that flat can rent out for £700 a month. I'll explain how we get an accurate rental figure in future. But first we need to get to grips with reality. The vast majority of people don't have access to £130,000 in cash, plus legal fees, plus stamp duty. So we need to use a buy-to-let mortgage. Let's say you're working a regular 9-to-5 job. You've started putting money aside into a savings account. You're saving up to buy your first buy-to-let property. You want to utilise a buy-to-let mortgage to reduce the amount of cash that you need to pay up front and leverage the bank's money. A typical rule of thumb for buy-to-let mortgages is 75% loan to value. And loan to value is very simple. It's literally the value of the loan in comparison to the value of the property. So a £100,000 property with a £75,000 mortgage would be a 75% loan to value. That would mean you would require a 25% deposit and the bank fronts the other 75%. So for that same flat at £130,000 in Glasgow, you would require £32,500 for a deposit. You would also need to pay a solicitor so they can actually process the transaction legally. You can't just shake hands with the seller and say, okay, I'll transfer you the money and the deal's done. You need solicitors to make sure it's done properly. We'll budget £1,500 for that. A buy-to-let property is not your main residence, so you need to pay additional dwelling supplement, which in Scotland is 6%. So that's another £7,800. And if you're serious about investing, you would use a finance broker like myself to find you the best lending for your situation. Let me take off my finance broker hat for a second and let you know, as an investor, how important this is. Using a broker is worth its weight in gold. Don't just walk into your high street bank and ask to speak to the mortgage advisor. Speak to a mortgage and finance broker who has access to the whole of the market. This means they have access to various lenders and they can get the best funding suited to you. In my own experience, when I tried to buy my first property, I was laughed out of the bank because they could not find me a mortgage. There was no way they were going to give me a mortgage because I was self-employed and they didn't have any interest in helping me out. At that point, I thought there was no chance I was ever going to get on the property ladder, not for a long time anyway. But then someone suggested I speak to a mortgage broker rather than the mortgage advisor at the bank. So I did, and they got me a mortgage. Like that. They figured it out. They found a lender for me. Broker hat back on now. If this is something that you are looking for, send me an email at r.corbett@gofinancialservices.co.uk and I can help guide you through the process of acquiring funding for your properties. In this scenario, we'll budget £500 for a broker. So for the £130,000 property that you've bought, you need £42,300 up front to cover your costs. You're also best to have a little bit of a buffer in your account as well, just for various costs like getting a property up to a good standard. Maybe it needs a lick of paint, or it needs interlinked smoke alarms and gas safety certificates to make sure it's compliant. So a couple months have now passed, you've paid your deposit, you've paid your ADS, everyone's paid. It has been a couple months because lenders, solicitors and pretty much everyone involved in a property transaction are slow, except brokers of course. We are extremely quick. You've completed on the property, the lender has released the funds to the seller, you've paid your deposit, and you now have the keys. You now also have a mortgage of £97,500. Depending on your preferences, you can either take this in an interest only basis or on a repayment basis. Here's the difference. A repayment mortgage is more expensive per month. This is because you're not only paying the interest, you're also paying the balance of the debt down every month. So when you get to the end of your 25-year term, for example, you don't have any mortgage to pay on the property. This is typically the type of mortgage you take when you buy your own residential property to live in. However, an interest-only mortgage is exactly what it says in the tin. You're only paying the interest. So let's say you have a 6% interest-only mortgage on this property. We take the loan amount, £97,500, we multiply that by 0.06 to get us 6%. That gives us £5,850. We then divide that by 12 to find out what that would be per month, and that gives us £487.50. That would be your mortgage payment. So let's just use the £700 per month rental figure that I gave earlier. Again, remember, I made that number up, so we're going to see if that would stack up. We take the £700 rent and we subtract the £487.50 mortgage. That gives us £212.50 cash flow after paying the mortgage. But let's say you don't want to manage the property yourself. I certainly don't. So you pay a letting agent to handle that for you. We'll call it 10% for a nice round number in this instance, but it can be as high as 15%. 10% of your rent is £70. So we subtract that and the cash flow is now £142.50. Landlord's insurance, let's call it £25 per month. That's roughly what I pay. You're now at £117.50 per month. And that's not accounting for putting any money aside for repairs and maintenance as well. Discounting that, at £117.50, excluding repairs and maintenance, we multiply that by 12, and that gives us £1,410 per year in positive cash flow. To find out the return on investment, we now divide that by the cash that we invested up front, £42,300, and this gives us a return on investment of 3.33%. So you tell me, is that a good investment? In my opinion, no, it doesn't even beat inflation, and there are banks who are offering higher than that in some savings accounts. So in this instance, if the rental figure was £700 for that property, probably wouldn't buy it. So as I previously mentioned, this video was just hypothetical numbers. Just a quick illustration on how buy-to-let works, not in-depth numbers or real-life numbers. I just wanted to give a very basic explanation of buy-to-let investing for people who are completely unfamiliar. I am, however, going to make this the first video in a series of videos about investing in property. So make sure you subscribe to the channel for future videos. I'll be talking about how to buy properties to renovate and flip, how to buy properties to renovate them and hold them in your portfolio and refinance to pull some money out, how to properly run the numbers to establish if a deal is good or not, how to establish what the actual rental number would be rather than just plucking £700 out of thin air like I did today, and pretty much anything else to do with investing in property. If you do have any specific questions about investing in property, leave them in the comments below, because I will use that as a reference point for adding extra videos to the series. So stick around, subscribe to the channel, and there will be more videos on property investments coming soon. Thank you as always for watching, folks. Take it easy.